What if I told you that one of the most dramatic financial meltdowns in American history didn't come from greed, but from fear? That before Wall Street had computers, algorithms, or Reddit armies, the entire US stock market was nearly toppled by rumors, panic, and a handful of bad decisions. Today, we're diving into the wild, chaotic, and totally underrated financial roller coaster known as the Panic of 1972, a moment that shows exactly how quickly speculation can turn into disaster, and why understanding this era might save you from the next big crash. Hey everyone, welcome back to the channel. It's the Rich Turtle, the personal finance storyteller who makes money history actually interesting. Today's episode is a deep dive into a period that shaped modern Wall Street more than people realize. It was messy, dramatic, unpredictable, and full of characters who thought they could outsmart the market, until the market reminded them who's boss. So, buckle up, because this is not your dry high school history lesson. This is the real, human, chaotic story behind the Panic of 1972. A story full of speculation, shady companies, wild investor psychology, and lessons that still matter today. The world before the panic. Imagine America in the early 1970s. No smartphones, no online trading, no YouTube finance gurus telling you to invest $100 a week. Markets were powered by telephones, newspapers, rumors, and gut feelings. People got stock tips from neighbors, coworkers, and taxi drivers. And in 1972, Americans were hungry for wealth. The country had just survived the recession of the late 60s. President Nixon was promising stability, middle-class families were finally getting comfortable with the idea of investing, and a wave of flashy new companies, many of them tech-adjacent for their era, were hitting the market. This was the age of the Nifty 50, a group of stocks everyone believed could never go down. Sounds familiar, right? Kind of like the tech stocks people worship today. Companies like Xerox, Polaroid, IBM, and McDonald's were treated like unstoppable superheroes. It didn't matter what their earnings were. It didn't matter if the valuations made sense. Investors just kept buying because they believed the story. This wasn't investing. This was faith-based financing. And faith, as we're about to see, has a breaking point. The bubble begins. By early 1972, speculation was everywhere. People were buying stocks they didn't understand, newspapers hyped the next big winners, brokers cold-called families to push shares. It was the original version of TikTok hype stocks, but with worse haircuts. Even seasoned investors got caught up in it. They saw the market rising and assumed it would keep rising. They ignored warning signs like overvalued companies, weak earnings, corporate fraud cases increasing, inflation quietly growing in the background. If this sounds like 1999 or 2008 or even 2021, that's because history doesn't repeat itself. It rhymes. And in 1972, the market was humming like a ticking clock. The trigger. Fear enters the chat. There wasn't one single boom moment that set off the panic. Instead, it was a series of smaller sparks. Economic data started weakening, inflation was rising faster than economists predicted, corporate earnings slowed, the Nifty 50 cracked. A few big companies reported disappointing numbers. Rumors spread. Whispers of bankruptcies, insider selling, and accounting scandals started circulating, even for companies that were completely fine. The media fanned the flames. Headlines became scarier, analysts turned cautious, commentators questioned whether the long bull run was over. Markets don't crash because of facts. They crash because of emotions. And in 1972, the dominant emotion became fear. It started small. A few people pulled money out, a couple of funds moved to safer assets, but then more investors noticed the selling, which triggered more selling, which triggered even more selling. And just like that, the invisible thread holding investor confidence together snapped. The panic hits full force. By late 1972, the market was in full meltdown mode. The Dow Jones dropped sharply. The S&P 500 followed.
Companies once considered untouchable fell 20%, 30%, even 50%. People who had invested their life savings suddenly saw them evaporate. Brokerage firms scrambled to reassure clients. The government tried to downplay the crash. But the truth was simple. Speculation had turned into destruction. The news cameras zoomed in on panicked investors rushing in and out of brokerages, clutching newspapers, trying to understand what was happening. Some blamed the Federal Reserve, some blamed corporations, some blamed the system. But beneath all the noise, the real problem was psychological. Investors weren't thinking long-term. They weren't analyzing fundamentals. They were chasing hype. And when the hype died, so did the market. The chain reaction. What broke next? The panic didn't stop at Wall Street. It spread everywhere. Retail investors lost trust. Small companies collapsed. Businesses that depended on investor funding ran out of cash. Banks tightened lending, loans became harder to get, borrowing slowed, spending dropped. The economy slipped toward a recession. 1973 and 1974 would become two of the most painful years in U.S. economic history. But the panic of 1972 did something even more important. It exposed how fragile the market's belief system was. The unsung heroes, investors who got rich. Now, here's where the story gets interesting. Not everyone panicked. Not everyone sold. A small group saw the chaos for what it really was, a historic buying opportunity. These investors, many of them unknown at the time, understood a simple truth. When everyone is selling emotionally, real value appears. They bought shares of companies like Coca-Cola, Disney, McDonald's, Johnson & Johnson, IBM. These were companies that still had profits, still had growth, and still had strong foundations. But during the panic, they were trading at fire sale prices. History shows that investors who bought in late 1972 and held through the next few years made astonishing returns. This is the part people forget about panics. Fear creates millionaires, if you know how to stay calm.
The aftermath. How this panic changed America. The panic of 1972 forced Wall Street and the government to rethink how markets should operate. Here are three major changes that happened. Number one, stronger corporate regulations. Companies began facing stricter financial reporting requirements to reduce fraud. Number two, more education for retail investors. The panic inspired decades of new financial literacy programs and investment guides. Number three, the rise of index funds. Investors realized they needed safer, diversified ways to invest, which contributed to the growth of index fund strategies in the years ahead. Perhaps the biggest takeaway was this: the market didn't fail. People failed to understand the market. The personal finance lessons we can learn today. So what does all of this mean for us in 2025 and beyond? Because let's be real, we're living in a world where speculation is stronger than ever. We have meme stocks, crypto hype cycles, AI-driven trading, social media influencers pumping random tickers, tech valuations that sometimes make zero sense. The same emotional patterns that fueled the panic of 1972 still exist, just dressed in modern clothing. Here are the top lessons the panic teaches us. Lesson number one, never invest based on hype. If everyone is talking about a stock, posting about it, or promising overnight riches, the smart investor steps back and asks, does the math actually make sense? Lesson number two, markets crash faster than they rise. In 1972, it took years for the market to climb, and only months for it to collapse. This is why you never invest money you can't afford to wait on. Lesson number three, fear creates opportunities. When the media freaks out, when social feeds explode, when the charts turn red, that's when disciplined investors quietly start buying quality assets. Lesson number four, fundamentals always win in the end. Speculation fades, stories fade, hype fades, but companies with consistent profits, strong management, real demand, durable advantages always recover.
The Rich Turtle Wrap-Up. So here's the real message of the panic of 1972. Markets don't move because of numbers. They move because of people. People full of fear. People full of greed. People chasing shortcuts. But if you can stay calm, stay educated, and stay focused on long-term investing, then every panic, every crash, every meltdown becomes nothing more than noise. History doesn't punish prepared investors. It rewards them. And that's why we study moments like 1972. Not to memorize dates, but to understand mindsets. If you enjoyed this financial story and want more money history breakdowns told in a way that doesn't put you to sleep, make sure to smash the like button and subscribe to The Rich Turtle. Drop a comment and tell me, which financial era should I break down next? And remember, slow and steady gets wealthy. See you in the next video, Turtle Nation.